Thanks very much, JP. There's so much I want to say about the previous two commentators' comments, virtually all of which I agree with wholeheartedly. I'd love to put some thoughts on those, perhaps in the discussion period. JP has asked me to really focus my comments on a view of farmland prices, which may be a little bit more nuanced, I think, than some of what you may have read or some of the data that you've looked at. But before I do that, I just want to give you a very quick introduction to Bonifield, only to make it things in context. Ron mentioned that he has a son-in-law who's in a different business who leased virtually all of their assets. As odd as this may sound for someone who runs the largest farmland investment company in Canada, we don't think of ourselves as buyers of farmland. That sounds crazy, I know, but that's not what we think. My background is in finance, and we came up with this idea from a sister company that was Canada's largest sod farming business that was desperately frustrated by their lack of ability to access the same kind of capital that other businesses in Canada have been able to access for many, many years, namely sale-leaseback financing. There was none available when we went looking for it with this other company. And in there we thought, okay, here's an idea. There's a desperate need amongst the agricultural sector in this Canada for investment, for access to capital, for new forms of capital. And so what we are doing is we're providing effectively equity-like capital in the form of sale-leasebacks to farmers. So we vision ourselves not as buyers of farmland, but rather as partners, long-term partners with successful, young, progressive Canadian farmers right across the country, and we see ourselves as their financial partner. The fact that we kind of take ownership of the farmland and lease it back to them on a very long-term basis, virtually a perpetual basis, is almost incidental to what we do. So the comments I'm going to show you, obviously we are very focused on the questions of farmland and where it's going, and I'm going to share with you some of those thoughts. Okay, so firstly, there's been much ink spilled on this question. Is the fact that farmland prices that commodity prices have softened in the last year compared to where they were in 2012. Is this a red signal? Is this a red flag? Are we into another potential farmland bubble? Are we likely to see a decline in prices like we did in the 1980s? Believe me, this is a question which does not just occupy my days, but occupies some sleepless hours at night. So let me try and answer that. First of all, a couple of observations. Commodity crop volatility is nothing new. I mean, this goes all the way back to 1969. Yes, volatility has increased lately with tighter supply and demand characteristics, but volatility is something which the agricultural sectors are masters at dealing with. And in fact, if you go back much longer in time, this chart goes back all the way to 1970, and what you see on the lower axis is a commodity price index, agricultural commodity price index, and farmland values are in green. Well, something's wrong here, right? Because clearly, for much of that period, I was born in 1961, for much of my life until 2006, commodity prices were all over the place, but they were generally in a downtrend, yet farmland prices went up. This is patently ridiculous. How could that possibly happen? It's only really been since 2006 where we've had this secular increase in commodity agricultural prices, which has spurred further the farmland. But clearly somebody was being very irrational in there for a good 30 years from the 1960s onward, because why would farmland prices increase when their output is decreasing? So clearly something's wrong. And something has gone wrong more recently. This is a chart, again, in green you're seeing changes in Canadian farmland values. In gray you're seeing corn prices. Well, look, for an entire decade, from 1994 to 2005, you had a fall in corn prices, but yet Canadian farmland prices continue to increase. Clearly farmers are a very irrational bunch. They're bidding up farmland, as Ron says. They're bidding up farmland prices when their prices of their output is falling. So how do we explain this? Well, of course, we explain it that revenue, the farm equation really is made up of a number of things. It's not just crop prices that matter. It's price times the yields, You've got your costs, and really it's a function of net income. And of course, in recent years, in the last year, you may have seen prices falling, but we've had bumper yields. So revenues have actually been quite high across Canada. Input costs have fallen significantly in the last few years. You just need to look at prices of potash. Natural gas prices declining have really benefited farmers. I know every good farmer likes to complain about how difficult business is, and it is. Fixed costs have been declining slightly because over the years, because interest rates have been low. So we have been in this period, long-term period, where net income has continued to increase, and it's really net income that drives farmland prices. In fact, this goes back a couple of years, a study that we did where we were trying to identify what it is that drives farmland prices in Canada. This is a correlation analysis. I'm sorry if it's a little bit small. I hope you can read it. But what it says is that without question, the number one driver of farmland values in Canada is farm revenue, which is a proxy for farm income. Unfortunately, as you all know, farm income data, as reported by StatsCan, is hopeless because it's farmers are on a cash accounting basis, and a good farmer never makes money. They make lots of cash, but they don't make any money, and they sure don't pay any taxes. So farm revenue is really a proxy for farm income. Next is farm size. Well, that's a proxy for farm efficiency, consolidation. We've seen lots of consolidation over the last 20 years, and that's another key driver. Cereal yield. So this is a function of crop yields. These are the key drivers. If you look way down the road is agricultural commodity prices, which have a much smaller impact on farmland prices. So really, the bottom line is all about income. So where are we? Something else to keep in mind is that yes, crop prices have come off in general, particularly grain prices from their highs, record highs in 2012. But keep in mind, on a historic basis, we're still in the top third quartile of crop prices. If you go back over the last, I think this goes back whatever 2,101 days is, divide that by 3, about 7 years, I guess. So, we're still at historically quite high prices. So it's still a good time for farming, for agriculture, despite the fact that crop prices have come off. Okay, so are we likely to see a repeat of the dirty 80s? One thing I'd like to say is that, there were some charts shown earlier about absolute levels of debt. And this is something which we have to be very careful in talking about, particularly, I have to say what a pleasure it is to speak to economists. I'm used to speaking to, jaundiced, skeptical investors who tend to make decisions based on their opinions. It's such a pleasure to talk to an audience that base their decision on objective data. Very refreshing. So look, this chart talks about the annual change, okay, not absolute level, the annual change in debt in the Canadian farm sector going back to 1972. And you'll notice that back in the 70s, the period that led into the bubble, we had accumulations of debt of well over 15% per annum. I mean, there was no way that and I'll show you later, that income increased in the farm sector to keep pace with that. Incomes were fairly flat. So there was this incredible increase in debt in that period. If you look more recently in the 2006 period where farmland prices really took off in Canada, the increase in debt per annum has only been about 5.5% a year, which is well below the rate of increase in profits. So you can understand why the situation is a little bit different when we're speaking about debt. Yes, absolute levels of debt have increased, as you would expect, right? If you're buying a piece of property for $1,000 and you're going to get a 70% mortgage on it, then you've got $700 in debt, whereas if you bought it a few years ago for $10 and you have $7 in debt, of course absolute levels are increasing, but that's not really what's relevant. What's most relevant is on the margin and how it relates to your profits. And if you look at the total level of debt in Canada by sector, certainly lenders are being more conservative than they were in the 73 to 81 period, the period that led up to the bubble. In fact, you really have not seen an overall increase in lending practices. There's certainly been a shift between the private sector and FCC, but generally there hasn't been an enormous ramp in new lending by these agencies over time. So I think bankers, the message here is that bankers have learned their lesson from the 1980s and are being quite rigorous in the analysis. Okay, so now here's where we get into some of the meat of it. This chart in brown or in gray here compares the increase in farmland values in the 1973 to 81 period, the period in the run-up before the bubble burst, with the change that we've seen from 2006. So we have seen a dramatic increase, but it's by no means unprecedented, and it's by no means the degree of what it was in the 1970s. Okay, so that's one fact to keep in mind. Second fact, this is as I mentioned earlier in the correlation analysis, there's no question that gross income is the key driver of farmland values. And you can see, this again goes back to 1973, that by and large, there's been an incredible correlation between income and farm values. In fact, if you do a regression analysis over the entire period, 1972 to 2012, you see that both gross income and debt levels are statistically significant to the 99th percentile confidence range. I mean, this is pretty stunning. If you repeat that same math and you accept out that period of the bubble, guess what? Only gross income is statistically significant as a driver of farmland values. So this says to us that debt is not a problem like it was in the 1970s leading up to it. We're just not seeing that divergence that we did back in the 70s that led to the problem. So this makes us a little bit more sanguine about the outlook going forward. But what really makes us, I think, more sort of what I think is more intriguing is when you begin to break it down and you compare recent farmland values to changes in income. And what you're seeing here, the index changes in real, so this is inflation adjusted, gross farm incomes in the two periods. You'll see that during the 1970s and the lead up, there were changes, but there was really no fundamental shift. There was no dramatic increase in income. Look what's happened in the 2006 to 2012 period. I mean, we have seen an enormous increase in the profitability of this sector. So it makes sense to us that therefore farmland values should increase in line with those increases. Now, just to beat a dead horse and really make it blunt, if there's one picture I'd like you to remember from this presentation, it's this one. You see, this is an index of crop sector income divided by the farmland values. Okay, so it's a relative factor. So you see this huge increase in the 1970s of effectively the expensiveness of farmland, but we're simply not seeing that today. We are seeing that farm prices, and if anything, there's been actually a slight decrease because the farm sector has just been so profitable. So, and we've seen this this is an analysis that we did. It's sort of very much an estimate. But what we tried to do is we said, look, let's take a look at Ontario and let's take a look at the average farmer who's going to finance his farmland with a mortgage. And let's say he's going to take on 65% of the value of the land is going to be financed by a mortgage. Let's look at the mortgage rates. Let's look at his income that he's generating from an average crop, an average acre of land. So that includes some yield estimates, some price estimates, and how much of the revenue that he's earning from that acre of land is being used to pay the bankers. Right? How much of his production is going to finance his land cost? Well, we were shocked at this. Even in Ontario, where you've seen dramatic increases in land prices. If you look at soybeans, it's been flat to downward, and if you look at corn revenue, there's been a similar pattern, maybe a little less volatile. So there's actually been, and if you take it all the way back to the beginning of the period, there's actually been a decrease over time. If you look at Western Canada and the crops that are grown there, Saskatchewan as an example, farmers, the average amount of production off an average acre of land that's going to pay for the financing cost of that land has declined dramatically over time, despite the fact that there's been this huge increase in land. So what's happening here? Farmers are better off. Farmers are earning more. Farmers, frankly, are better business managers than they have been over time, and we're seeing that their ability to finance acquisitions of farmland, even at increasing prices, has improved over time. Now, of course, what this analysis ignores is the fact that the farmer still has to come up with that enormous, if he's getting a 65% mortgage, he's got to come up with a big slug of equity to be able to finance it. And that's where we come in. Because in our model, we are the equity player essentially in the farmland sale leaseback world. But the message here is that we don't see any irrationality in the Canadian market with respect to farmland prices. We don't see an impending bubble. We would be very concerned if we were to see debt accumulate much faster than increases in income. We would be very concerned if we saw dramatic spikes in interest rates, which made current levels unsustainable. We don't see dramatic increases in interest rates in the near term, nor do any of the federal and central bankers that I'm aware of. And we would be very concerned if we were to see something secular that indicated that the long-term trend towards rising gross income in the farm sector, something that broke that down, something like, but here we've got very big trends going in the favor of Canadian farmers. We've got climate change, which is going to impact US farmers and farmers around the rest of the world far more than it's going to impact Canada. We see access to water, we see growing demand for food around the world. We see all of these trends intact. If any one or more of those trends, if somebody suddenly come up with a very, very cheap way to desalinate salt water and therefore make it reasonable to irrigate, all of Saudi Arabia, then I would say, okay, maybe we should reconsider. But we don't see that on the horizon. So our approach is to remain very disciplined, very cautious. It was said earlier that investors are not the ones driving prices, and my final point would be just to echo that. By our estimation, there's roughly $300 billion worth of farmland in this country. And from what we can tell, ourselves included, there might be a few hundred million, maybe $500 to $600 million worth of farmland that is owned by the likes of us and investors in this country. There is no way that investors are driving up the prices of farmland. It's just not happening. And the other point I would make is that there's something like $15 billion of farmland that trades hand in this country each year, just farmer to farmer. There's a minuscule amount of that that's going to investors. And I would say the last thing is that from an investor's perspective, we can't pay $17,000 an acre for your land, Mr. Farmer. I'm sorry. We can only pay what is a rational value for the land, that the farmer is able to earn enough that he can pay us an acceptable rent, because if he can't pay the rent, we're in a world of hurt. So we are the ultimate rationalist, in the market. We've never paid top price for a land. We simply are unable to. So that's the extent of my comments, and I'm looking forward to the question period. Thank you.